index funds, mutual funds, hedge funds, or ETFs. I'm sure you've heard about this before. Many people avoid investing because they lack the skills to analyze and choose stocks or investments effectively. In this video, I'll explain these types of investments straightforwardly and practically. We'll start with what a fund actually is, then go over the different kinds, how they're managed, the risks involved, the fees you might pay, the strategies they use, and most importantly, who they're really meant for. So please, give me 10 minutes and I'll give you the knowledge most people take years to figure out. But first of all, I would like to make clear that this is not any kind of financial advice. So first off, what is a fund? Think of a fund like a basket that holds multiple investments. Instead of buying Apple stock, Microsoft stock, and Tesla stock separately, you buy one fund that holds all three plus hundreds of other companies. You get instant diversification without needing to pick individual stocks yourself. All funds, whether index funds, mutual funds, ETFs, or hedge funds, work on this basic principle. They pool money from many investors, and a professional fund manager invests that money into different securities like stocks, bonds, or other assets. But here's where they differ dramatically in how they're managed, who can invest, and how much they cost. First, let's talk about index funds, the passive approach. Let's start with index funds. An index fund is a type of fund that tracks a specific market index like the S&P 500, FTSE 100, or Nigeria's NGX 30. The goal is simple: match the performance of that index, not beat it. Index funds are passively managed, which means the fund manager isn't actively picking stocks. They're just buying all the stocks in the index in the same proportions. For example, if Apple makes up 7% of the S&P 500, an index fund tracking the S&P will have 7% of its money in Apple. The advantage is extremely low fees. Most index funds charge expense ratios of 0.03% to 0.20% annually. If you invest $10,000, you're paying just $3 to $20 per year in fees. These funds also tend to be more tax efficient because they don't trade frequently. According to Morningstar data from 2024, only 13.2% of actively managed funds beat the S&P 500. This means index funds, which simply track the market, outperform most professional stock pickers over the long term. Legendary investor Warren Buffett famously bet that an S&P 500 index fund would beat a selection of hedge funds over 10 years, and he won. Index funds are perfect for beginners and long-term investors who want low costs, simplicity, and proven results. They're available through most brokerages and typically have low minimum investments starting from $100 to $3,000 depending on the fund. Secondly, mutual funds, the actively managed option. Next are mutual funds. A mutual fund is also a basket of investments, but unlike index funds, most mutual funds are actively managed. This means a fund manager and their research team actively pick stocks they believe will outperform the market. Mutual funds are priced once per day after the market closes at 4 p.m. You can't trade them throughout the day like stocks. When you place an order, it gets executed at the end of day price called the net asset value, or NAV. The advantage of mutual funds is professional management. The fund manager researches companies, analyzes financial statements, and makes strategic decisions on when to buy or sell. In theory, this should lead to better returns. However, this active management comes at a cost. Mutual funds typically charge expense ratios of 0.5% to 2% annually. Some charge front-end loads, which are sales charges when you buy, or back-end loads when you sell. These fees significantly eat into your returns over time. According to recent data from 2025, the average mutual fund expense ratio is 0.57% compared to just 0.42% for ETFs. Over 20 or 30 years, that difference compounds into tens of thousands of lost returns. Mutual funds are suitable for investors who believe a specific fund manager can beat the market, or for those investing in niche areas like emerging markets or specific sectors where active management might add value. The minimum investment varies but typically ranges from $500 to $5,000. Next is the ETFs, the flexible hybrid. ETFs, or exchange-traded funds, combine features of both index funds and stocks. Most ETFs are passively managed index funds, but they trade on stock exchanges throughout the day, just like individual stocks. The key advantage of ETFs is flexibility and cost. You can buy or sell ETFs anytime during market hours, use limit orders, stop-loss orders, and even short sell them. The expense ratios are typically very low, averaging 0.42%, with many popular ETFs charging as little as 0.03%. ETFs are also highly tax efficient. According to Morningstar, only 6.5% of US stock ETFs distributed capital gains to investors in 2024, compared to 78% of mutual funds. This means you pay less in taxes, especially if you're investing in a taxable account. Another advantage is accessibility. You can buy an ETF for the price of one share, often $50 to $400, and many platforms now offer fractional shares, meaning you can start with as little as $10. Popular ETFs include SPDR-S and P500 SPY, Vanguard Total Stock Market VTI, and Invesco QQQ. For Nigerians, platforms like Bamboo make it incredibly easy to invest in US ETFs. You can access the same ETFs that American investors use, with fractional shares and low minimums. Check the video description for the Bamboo app link. ETFs are perfect for most investors who want low costs, flexibility, tax efficiency, and the ability to invest small amounts consistently. This is exactly my approach. I don't wait until I have $1,000 before I start investing. I've developed the habit and I've been consistent with smaller amounts, building my portfolio through ETFs. And lastly, let's talk about the hedge funds for the ultra-wealthy. Finally, hedge funds. These are completely different from everything we've discussed so far. Hedge funds are private investment vehicles only available to accredited investors, which typically means you need a net worth of over $1 million or annual income over $200,000. Hedge funds use aggressive strategies that mutual funds and ETFs can't. They use leverage to amplify returns, short selling to bet against stocks, derivatives like options and futures, and complex trading strategies. The goal is to generate positive returns regardless of market conditions, hence the term hedge. The fees are astronomical. The classic structure is 2 and 20, meaning 2% annual management fee plus 20% of all profits. If the fund makes $1 million in profit, the manager takes $200,000 plus the 2% management fee. Compare that to an index fund charging 0.03%. The minimum investment is typically $500,000 to $5 million. Hedge funds also have lockup periods, meaning once you invest, you can't withdraw your money for 1 to 3 years. And there's no guarantee of returns. Many hedge funds underperform the market after fees. Hedge funds are not for regular retail investors. They're for ultra-high net worth individuals and institutions who can afford massive losses and want alternative investments uncorrelated with the stock market. Now, here's my recommendation. For 90% of investors, ETFs and index funds are the best choice. Start with broad market ETFs like VTI for US stocks or VO for the S and P500. These give you instant diversification, low costs, and proven long-term returns. If you're investing through a 401k or pension plan that only offers mutual funds, choose low-cost index mutual funds over actively managed ones. Look for expense ratios under 0.20%. Avoid hedge funds unless you're already wealthy and looking for alternative investments. Even then, most financial advisors recommend keeping the majority of your portfolio in simple, low-cost index funds and ETFs. Remember, it's not about waiting for the perfect amount. I've developed a habit of investing consistently with whatever I have, whether it's $10, $50, or $100. Consistency beats timing. If you're in Nigeria and want to start investing in ETFs, download the Bamboo app from the link in the video description. You can start with as little as $10 and build your portfolio gradually. That's it for today's video. If you found this helpful, smash the like button and let me know in the comments which type of fund you're most interested in. I'll see you in the next video.